Welcome to the fifth installment of the TrustleBridge Capital monthly series entitled Asking for Your Friend. This is where we take your questions that have come in on anything from investment to financial planning topics. And in this segment, we're going to explore exchange-traded funds. These are the primary securities or investment vehicles that we own in your TrustleBridge accounts. Before we get started, have a few quick words from our legal team. With that, we can go ahead and dive right in. At a high level, ETF is an acronym, refers to exchange traded funds. In essence, what that is, they are investment vehicles. They trade like a common stock, so on an exchange, and then very similar to a mutual fund, they will own a collection of underlying investments. Now, depending upon the ETF's mandate, they could own individual stocks. Those could be globally diversified or stocks of a particular country, stocks of a particular size, small, mid, or large. You could own names in a particular sector or even with a particular focus, be it dividends or growth. On the center column, you'll see the ETFs available on the bond or the fixed income space as well, offered through the many different asset classes within that investment universe. Same thing as it relates to physical commodities. In the US, there's nearly 3,000 ETFs that have a very wide variety of different exposures. So you are able, if you have a particular view, to most often be able to express that by owning a particular ETF. Now, what are the benefits of owning ETFs? There's four key reasons that come to mind. The first is, we'll see here, diversification. You've probably heard of the concept, or the phrase rather, don't put all of your eggs in one basket. This in essence means diversifying those underlying holdings. So say, for example, you wanted to invest in large cap US companies. You could buy a singular ETF that owns the S&P 500, or you could go out and buy each of those 500 names individually. Obviously, the former approach is going to be much more efficient and still giving that same level of diversification. Secondly, comes down to cost. Relative to mutual funds, ETFs tend to be much more cost effective, despite the fact really designed to do the same thing. This is referred to as the internal expense ratio. Typically, this can be found on the front page of a ETF fact sheet. And the key to focus on here, ETFs can start typically as low as 5 basis points. That's 0.05 of 1%. For more complex ETFs, you may see their cost is around 30 to 40 basis points. Again, that's 0.3 to 0.4 of 1%. In contrast, tends to be much more cost effective than the mutual fund community, where on average, those can range anywhere from 80 to 100 basis points. The third piece we focus on here comes down to the fact that they're traded intraday, very similar to a stock on a common exchange. There's no negotiation. You can go right out to the market. You can set certain trading parameters as you look to enter or ultimately exit a position. But at the end of the day, by trading on an exchange, that is done much more efficiently. So as opposed to selling a mutual fund and having to wait for those proceeds to settle before taking a distribution, or even if markets are incredibly volatile intraday, ETFs, you can go out, you can make those buys and sells where you see the most opportune and appropriate times to do so. The last piece here, and arguably one of the most important, is their tax efficiency. So if you were to go out, own a series of individual stocks, as you would trade those stocks over time, any buys and sells that were ultimately profitable, you would eventually be taxed on. Those could either be taxed as ordinary income rates, depending upon if you held them for less than a year or not. Same thing if you own a mutual fund. Those mutual fund companies are taxed on their underlying gains. That tax is then passed along to end investors within that mutual fund. Although ETFs conceptually designed to do the same thing as mutual funds, in the eyes of the IRS, they are taxed very differently. When they trade, those transactions viewed more as exchanges. So most often, they are not spitting out cap gain distributions. Why that's important is when we think about a year like 2022, you had both stocks and bonds that were down sharply, both down double digits. If you are a mutual fund investor in that environment, not only could you see your portfolio down double digits, but you may very well be receiving a tax bill on top of that. Certainly not a great feeling, but something that can make your progress towards your financial plan that much more difficult if you now need to sell assets at lower prices, locking in those losses in order to pay that tax. Again, well, ETFs still come with risk similar to a mutual fund. That tax efficiency, I do believe, translates in a overall improved experience. So that's all for today. I want to thank you for taking the time to join us. As always, encourage you to please submit your questions. Certainly, if we can go into any more detail on any things discussed today, happy to do so. We don't connect. Have a great St. Patrick's Day. Take care.